with Tesla rolling out driverless car ride testing in Texas this week, and Nvidia, of course, the dominant player in AI, investors are now asking me which one is the better stock to buy if I want to take advantage of the growing effectiveness of artificial intelligence. So I'll answer that question in this video. I'll compare Nvidia and Tesla on critically important financial metrics, and I'll look ahead and I'll forecast where I believe Tesla will be 5 years from now, where Nvidia will be 5 years from now, and I'll compare the two on revenue growth, returns on invested capital, operating profit margin, and also valuation to come to the conclusion of which one of these two stocks I would rather buy today as a long-term investor. So let's jump in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So let's start with comparing these two on revenue. So going all the way back to 2015, Nvidia and Tesla have demonstrated phenomenal growth over those years. Tesla has grown its revenue from $4 billion in 2015 all the way up to $95.7 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 41%. However, Tesla's revenues have been flat or declining since 2023. 96.8 billion in 2023, 97.7 billion in 2024, and down to 95.7 billion in the most recent trailing 12-month period. And from all the reports we've been getting about Tesla's car sales so far in 2025, it looks like 2025 will be another down year for Tesla's revenue. That's despite the fact that Tesla's management team told investors that they would grow car sales by 20 to 30%. Meanwhile, Nvidia has grown its revenue from around $4 billion in 2015 all the way up to $149 billion in the most recent trailing 12-month period, and most of Nvidia's growth happening since 2022. So while Tesla is struggling in recent years, Nvidia is thriving. Now, I expect that Nvidia's revenue growth will continue thriving for the next 3 years at the very least. Meanwhile, I expect Tesla's revenue will struggle for the next few years at the very least. Now, if or when the company actually starts selling driverless cars and earning revenue with driverless cars in meaningful fashion, then I suspect Tesla's revenue might rebound. But until then, the energy segment will continue growing, but I don't think it'll be enough to offset the declines in the automotive segment. Tesla told investors that it would deliver a lower priced model in the first half of 2025, and that's yet another forecast that Tesla has failed to deliver on, as well as I think the forecast for 20 to 30% automotive sales growth in 2025 will be yet another forecast that Tesla fails to deliver on. So I'm a little surprised to see investors so optimistic about Tesla's forecasts about driverless cars, given how Tesla has a history of overpromising and under-delivering. And even the CEO has sheepishly admitted to being overly optimistic about forecasts. So in 2025, you're not likely to see any meaningful revenue from driverless cars for Tesla. 2026, again, you're not likely to see any meaningful revenue from driverless cars for Tesla. 2027 is when you might start to see some revenue from driverless cars from Tesla, although again, I don't think it'll be in any meaningful fashion. And then 2028 or 2029 is when I think you can reasonably expect Tesla to generate any driverless car revenue at scale. So you're at least a few years away from generating any meaningful revenue from driverless cars. And that whole time, Tesla's going to be losing competitive advantage in the electric vehicle industry as it continues to sell. Basically, I mean, it updated the Model 3 and the Model Y, but they're basically the same cars that they've been selling for the previous 5 years, while the competitors have launched new and upgraded and more fresher models that are gaining market share in almost every part of the world, except I believe Denmark, where Tesla continues to dominate the EV market surprisingly. But in China, Tesla's losing significant market share. United States, Tesla's losing market share with many brands preparing to launch lower priced models in 2026. So Tesla's competitive prospects and revenue growth prospects look not very good for the next couple of years. And then you have to hope that driverless car technology, by the time Tesla develops the driverless car technology, you have to hope that there's a market available, because remember, Alphabet's Waymo and Amazon Zoox are already launching in several cities in the United States successfully, right? And so by the time Tesla launches its driverless cars, how many cities will Alphabet have already captured in terms of market share? So revenue growth doesn't look good for Tesla over the next few years, but I suspect if you were to measure revenue growth between 2030 and 2035, in those 5 years, perhaps Tesla will deliver better revenue growth than Nvidia. But I don't think it'll be that much, because Nvidia's technology is helping Tesla develop the driverless cars. So if Tesla starts developing driverless cars in large quantities, Nvidia is going to benefit as well. So they're both going to benefit if Tesla succeeds. However, if Nvidia succeeds, it doesn't mean that Tesla will succeed, because Tesla will not benefit as directly from Nvidia's success as Nvidia will benefit from Tesla's success. Okay, so not only is Nvidia delivering better revenue growth than Tesla, it's also generating much, much better profit margins, nearly 10 times better. I shouldn't say 10, more like 8 times better than Tesla. So you look at the operating profit margin, Nvidia generated 58% trailing 12-month operating margins, while Tesla generated 7.3% operating margins. And these 2 years of 2021 and 2022, when Tesla generated operating profit margins in the double digits, were, years that you have to put an asterisk on, because the company benefited from the supply chain shortages in the industry. Car makers were not able to produce as many cars, and so Tesla benefited as a result, being able to sell its cars at full price, at higher prices, and sell more of its cars than it normally would have. And every car maker benefited during 2021 and 2022, because they were able to sell cars at above asking price. I believe it was around 2021 or 2022. I recall I was mildly interested in buying an SUV. And when I called the dealership, they quoted me at $10,000 above MSRP for a $30,000 SUV. So that's the kind of environment the car industry was in 2021 and 2022. With all the shortages, dealers and car sellers were able to generate huge, huge margins, and that's unlikely to happen again. So I don't think it would be realistic to assume that Tesla will generate operating margins in the double digits again, unless they are meaningfully ramped up in the driverless car technology. So just where the business is at today, operating the same segments, the same business, I don't think they can recover those operating margins in the double digits. Very few automakers in the world generate operating profit margins in the double digits. It's one of the reasons I don't like the auto industry. It's not a very lucrative industry for investors. It's an industry with huge overcapacity. There is capacity to produce something above 120, 125 million cars in the world, while annual car sales hover between 85 million to 100 million, depending on, of course, if it's a cyclically down year or a cyclically up year. That's about the range you're going to get. So there's a huge oversupply in the industry. And when a new car maker comes into the industry, they add to the supply. And when an old car maker goes bankrupt, that supply doesn't go away. It just gets bought up by another car maker. So you just keep getting this overcapacity in the industry. And it's just one of the many reasons I don't like the auto industry as an investor. So another important metric is the return on investor capital, and it's yet another category where Nvidia dominates. In the most recent 2 years, returns on investor capital of over 140%, which I think is unsustainable for Nvidia. I don't think the company will generate returns on investor capital around anywhere above 100% anything beyond these next 2 or 3 years. Maybe for the next 2 or 3 years, it'll deliver these kinds of results. But beyond that, I don't think that these levels are sustainable. I think levels around 60 or 75% would be more reasonable, and that's still an incredible ROIC. Meanwhile, Tesla's ROIC has been declining. And again, 2021 and 2022 were outliers for Tesla at 15.7 and 27.7%. To some degree, 2023 as well, as the industry kind of recovered. I don't think you'll see these levels again unless, of course, the driverless car technology really ramps up, which I wouldn't expect at least in the next 2 years, probably not even in the next 3 years. Tesla's ROIC of around 8.5%. I would say higher than that. I would say returns on investor capital for Tesla can reach double-digit levels, but around 15% at the maximum without driverless car technology. So now that we looked at and compared the critically important financial metrics, let's look at valuation. And based on what I shared with you so far, you would think that Nvidia stock would trade at a more expensive valuation, wouldn't you? Nvidia is doing better than Tesla in nearly every metric that's important to investors. And so you would imagine, okay, a better business should be trading at a more expensive valuation. But that's not the case here because Tesla is a unicorn in the way that the valuation trades at, right? Tesla trades at a forward price to earnings of 153. 153. That's about at least 10 times more expensive than any car company and about 5 times more expensive than Nvidia and any other AI company. So Tesla's already trading at a valuation as if it's already developed driverless car technology and it's perfect and it's out on the roads and it's driving billions of dollars in revenue and billions of dollars in profit. It's trading as if that's already happened. That's what you can infer from this valuation, because just looking at the business where it is today, I shared with you, revenue is falling, profits are falling, profit margins are falling, and it doesn't look like they're going to recover unless there is driverless cars, right? Just looking at the business as it is, EV sales for Tesla are likely to continue declining. The energy segment is likely to continue increasing, but not enough to offset those declines in EV sales. And so revenue growth for the company without driverless cars is likely to be flat or declining. So you wouldn't be paying a premium valuation for a business like that unless you were expecting huge success from the pipeline of products that are coming in the future. And that's what Tesla stock is trading for. And so if I were to pick today between these two companies, it would be a very easy choice for me. I would pick Nvidia. In fact, I have picked Nvidia. I own Nvidia stock. And Tesla stock, for me, I'm closer to shorting Tesla stock than I would be to buying Tesla stock. I don't like this valuation for this company. Of course, they do have prospects with driverless car technology. They are one of the best car makers in the world, one of the best EV makers to be sure. The energy segment is likely to continue to thrive. They are at least 2 steps ahead of the competition there. But the rest of the business, I'm not very attracted to. And driverless car technology is at least a few years behind the competition and behind schedule, to be sure. So I'd pick Nvidia. For me, no brainer. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. it goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.